everyone, welcome to Taking Stock, the show where we take stock of the week gone by and prepare you for the next trading week. I'm Sonia Shenoy and with me from the Delhi studio is Surabhi Upadhyay. Hi Surabhi.
Hi Sonia, yes, I guess consolidation finally setting in, the bulls having to take a bit of a back seat, and a lot of talking points this week, Sonia, whether it was geopolitics and Western markets cooling off from Syria, South Korea, North Korea. These were the kind of words that we were getting. And then, of course, back home, earnings season kicking off.
Yes, indeed. In fact, you know, a couple of key points this week. We saw a bit of a sell-off in the markets, courtesy global cues. But that didn't really take the market out of the range. So the range is still 9100 to 9200 on the Nifty itself. But I guess it's also because technology stocks were weak post-Infosys numbers and the guidance that was weaker than expected. That really soured the mood there. And then you had a sell-off in the metal space as well. So a couple of pockets really dragged the market lower. But by and large, you'd have to say consolidation with a negative bias for the market. All eyes will be on what takes place next week because we have the big banking earnings that kickstarts as well, Surabhi. But for now, looks like there's just a bit of risk off and sideways move for the market. It won't harm anyone to, I guess, take a little money off the table at the moment.
I guess that's exactly what we've seen this week, Sonia. So let's get the headlines going. A week of consolidation on Dalal Street. The Sensex ends week lower by almost 1%, while the Nifty also sees a cut of around 0.5% for the week gone by. The Nifty Bank outperforms.
All right, Infosys reported a muted set of earnings in Q4 with FY18 guidance of 6.5 to 8.5% coming in at the lower end. Margin guidance was cut to 23 to 25%. A dividend of 14.75 rupees a share amounting to 13,000 crores cushioned the fall for the stock.
Global risk-off continues. The US dollar hits a one-month low as President Trump talks down the currency, says it is getting too strong. Safe haven gold trades at a 5-month high on the weakness in the dollar.
All right, well, joining us now to discuss the week gone by is Dheeraj Sachdev, the Senior Vice President and Fund Manager of HSBC Global Asset Management. Dheeraj, thanks so much for joining us on the show. You know, the key talking point this week was what happened with Infosys. It soured the sentiment in the entire sector, and it just gives rise to the concerns and the stress that the sector is going through with the way the management has reduced their guidance as well. As a long-term investor, perhaps in the IT stocks and in Infosys, how would you approach it?
Well, good evening, Sonia. Sonia, I can't talk about stock specific, but from a sector perspective, obviously the sector has been facing a lot of challenges in terms of growth and the recent headwinds being on the part of rupee as well. There is a renewed optimism as far as the US market is concerned. Obviously, we know that US market has been growing pretty smartly. And in terms of verticals like banking or financial services or retail, which account for a bulk of IT spending, it should augur well over time for the IT companies. On the other side, there are challenges in the form of hike in visa cost or relative growth being completely muted. So net-net, if you have to form an opinion, I think unless you have a compulsion of being an index fund player or a large cap fund player, you can at best be neutral because valuations in the sector are by your side. This is a sector which generates a lot of free cash flow, etc. So growth being an issue, I think at best you can be neutral because valuations is supportive.
Okay, so at best neutral in the IT space. But Dheeraj, what about the market as a whole? Are we looking at taking some money off the table because of the risk-off that we've seen globally? Or is this as good a time as any to put more money to work?
Sonia, if I have to take a step back, in the last few months, the rally has been led by several fundamental factors, be it state election verdict or demonetization's short-lived impact, or expected improvement in the corporate earnings, or even some resolution in the form of bank NPAs loans getting resolved over time. At least a step has been taken because this has been a major challenge for both the RBI and the government and the near-term GST rollout. So these are several factors that have contributed to the rally. Our sense is that even more bigger thing that is driving this rally is a shift in domestic allocation in favor of equities from the traditional physical assets, be it real estate or gold. I think this rise in equity culture is going to create a sustainable rally in times to come. So while we may expect some pause in the near term or short-term corrections, the correction is going to be only short-lived as the money will get invited into corrections. So while the market may have run ahead of time in terms of ahead of earnings growth, ahead of economic recovery, the broader market still trades at about 17, 18 times, so which is reasonable if not cheap. So net-net, if I have to stick my neck out and indicate that this is going to be probably bull market 2.0, which is going to be as elongated or as probably better than what we saw in the periods of 2003 to 2007. So maybe 12 to 18 months from now, we may be much better than what we are seeing today as we speak. But let me add a caveat to my bullish tone over the medium to long term. In individual cases, we are seeing stocks running ahead of earnings. So if there is any slight amount of earnings disappointment, those stocks will be punished. Besides, in many cases, valuations are not deserving for mediocre businesses in terms of their business model. And also in IPO listed companies, we are seeing unjustified inflated scarcity premium, and the valuations are in bubble zone. So one has to be very, very careful as far as IPO listed companies are concerned. So barring that, we find pockets of opportunity still existing in many of the mid-cap sectors.
Dheeraj, I'm going to take up your point on earnings because what you said is perhaps already playing out on the street. The kind of correction, for instance, that we are seeing in the metal side of the market, or what one will actually expect from the financials this time around, given the rally. So if you're saying that there could be pockets which are vulnerable to earnings disappointment, which are these big pockets or the prime pockets that come to mind?
Well, if I have to just give brief view on the earnings for the March quarter, I think NBFCs will stand out because you might see post-demonetization period, at least the AUM of the NBFCs or financial services companies will be better or come back to normalcy. They will have some kind of NIM expansion because of wholesale borrowing cost or lower bond yields. And as well as asset quality will be stable for several housing finance companies. Those CV finance companies or microfinance companies will have higher credit costs because of low collection efficiency. On the other hand, some of the sectors which can face problems in the March quarter numbers include cement or telecom sector because of higher competition intensity. Even autos, the volume number has been lower and because of heavy discounts or headwinds on account of higher raw material prices. But barring that, we believe the NBFC space or the private banks will probably stand out compared to the others. More so also the last year's March quarter numbers for corporate financial companies or corporate finance banks had accelerated bad loan provisioning, which may not be there in the March quarter numbers this year.
And where do you expect the earnings outperformance?
So as I mentioned, NBFC is one space. Optically, financials, including corporate banks, should stand out. You might also see metals optically looking attractive, though we are not really confident on the metals rally because we feel that large part of the rally in the last few months has been driven by more US announcement on infrastructure spending. So on a mere announcement, if these companies or these stocks or metal prices have rallied, those may fizzle out. Part of the rally is also driven by improvement in Chinese data as far as metal sector is concerned. But our sense is that more than the demand environment, it has been production cuts from China. But from a global metal perspective or a local metal perspective, we feel that integrated steel players stand a better chance because of protectionist regime or access to low raw material, lower raw materials in India, or they have the benefit of rising steel prices. So I think integrated steel players or some companies which will benefit on account of lower leverage or deleveraging should be the one to look after as far as metal segment is concerned.
Okay, Dheeraj, we have many more questions for you, but we have to head into a mandatory break. So let's do that. As we do that, let's listen into some important market opinion that we heard, not just opinion on the market, but opinion on stocks like Infosys as well through the course of the week. We'll come back.
It's not a growth stock anymore. And I think that's still what the market's hoping for, and it's just not going to get it going forward. I mean, the whole model for them has broken, and that's what you're seeing in terms of the earnings, and if you throw in the rupee headwind for them, then the stock could easily fall 10% before it's even worth looking at. Unless they can really kind of reshape themselves, of which they've spent many years now trying to do that, and it's not worked. Every company we speak to, has not seen any V-shaped recovery from demonetization. It's very slow, and just as recovery may be picking up, we'll have GST being implemented. So, I think it's going to be a poor year for earnings. I don't think the 20% growth was ever going to be met anyway, and we're already down to 15% earnings growth by most brokers. I suspect that's going to get down to 10.
We set our index targets shortly after the US presidential election, and we set them with a series of scenarios for a base case, a bear case, and a bull case. Okay. So our bull case, the Nifty equivalent, and we tend to set these all with the MSCI indices, the Nifty equivalent is about 10,500.
Do you think we have finally turned the tide in emerging markets?
I think we have, because everybody during the years ending at the beginning of last year, the 3 years where we are underperforming, everyone was concerned about interest rates in America. And they failed to realize that interest rates don't necessarily determine the direction of the market. Logically, you would think that higher interest rates would mean lower market and vice versa, but it's not always been the case in the last 10 years at least. So I think people are now beginning to wake up to that reality. And of course, they also realized that they were very underweight in emerging markets, so it's coming back.